Good morning, good evening, good afternoon, wherever you are in Davos, Switzerland, or in Columbus, Ohio, or Scottsdale, or the Bay Area, or anywhere in the world. We really appreciate you tuning in today. We have an all-star exporting, importing, trade group here with us today and around the world, and so we're really honored and pleased to kick off our conversation today with Dan Ujczo, who is the practice group chair of international and regional practices at Dickinson, Wright. And Dan, you've spoken on NAFTA, you've talked about USMCA and the transition there. You've got much more of a broad base around all different trade activity, and I don't know of anybody who's more on top of it, maybe in the world, than you. So thank you for participating today, and we look forward to hearing more from you on both the USMCA and just the trade update in general. Thanks, Dan.
Great. Good morning again. No matter or whatever it is where you are, and we're sitting here in beautiful Columbus, Ohio, where it's -1 degree Fahrenheit. So a little bit jealous of our friends in Phoenix and elsewhere around the world. Again, I'm Dan Ujczo with Dickinson Wright. Dickinson Wright, as many of you know it, as we've talked about in the past, is a law firm headquartered in Detroit, founded back in the 1870s. And since that time has expanded to 25 offices located throughout the United States, including in Phoenix, where you all are, and in Nashville, where we're proud members with Amos Smith of Globus Chamber and elsewhere, and Canada, which is we're one of the few law firms that have full service offices on each side of the border. Additionally, that means we're on the ground in these markets and understand some of the practical issues that we're confronting on trade, but also the policy and politics. We're involved in, I think it was 53 of the midterm election races for Congress, and so we maintain that and many more at the state level. Drawing from that subject matter and that where we are and all of those types of things, I would say that right now for businesses looking at the global trade environment, that we are on the march to managed trade. And to break that down a bit is first looking at managed trade. Is that, as you know, throughout 2017, we launched, the Trump administration launched a number of anti-dumping, countervailing duties, very traditional mechanisms, but almost doubled the amount of trade enforcement cases. And we talked about that during the last Globinar. We had safeguards on washers and dryers and refrigerators coming in, so kind of new tariff measures. We put tariffs last March on steel and aluminum. And then that followed up in May with expanding the list of countries, or at least removing the exemptions for those countries on steel and aluminum, but also adding the China tariffs. And that has continued throughout 2018. Even in the trade agreements that we've done, the new USMCA, which is the new NAFTA, and the Korea deal, those have components of managed trade. So companies have to pay attention to what's in there, because even though they're free trade agreements, there's requirements that 70% of steel and aluminum in the new NAFTA used in automotive needs to come from North America, which is new requirements. There's new labor value content. So even when we're doing things under the banner of free trade and open markets, they have these managed trade principles. And I say that because many companies, I would say 2/3 of the companies that are impacted by these measures have not done any preparation. You know, we do see about 1/3 involved in re-engineering supply chains or filing for exclusions on steel and aluminum tariffs in China. But many companies are still saying, well, this will pass. And that's the second piece of the march to managed trade. When we talk about march, I use it in two definitional ways, meaning first, that's the trajectory we're on. We're marching and we're going full steam ahead, whether it's the Trump administration, and of course we have a new Democrat-controlled House of Representatives. Democrats are in favor of managed trade, so we'll likely see more of this. This is the new normal. So anybody that thinks we're going back to March of 2018 before we're putting these tariffs on, that's a mistake in terms of policy and politics, where we're going. So this is the new reality. The other part is March the month. March of 2019 is where all of this is going to come to a head. And I'll just quickly summarize the 5 issues that we're watching that we think are most important for our businesses. Number 1 is China. The President put us on a 90-day clock to reach a deal. That clock expires at 11:59 on March 1st. And so we're working vigorously to get a deal. And I'll talk more about that very quickly, because I think that sets the stage for where we're going next on the U.S., Canada, Mexico agreement, which if we're on schedule, the earliest Congress can consider that is on March 15th, is when the International Trade Commission has to file a report. Unfortunately, because of the shutdown, we're likely going to be delayed on the issuance of that report. Nevertheless, we think that the new NAFTA issue will start getting attention around that March timeframe, if not before. Thirdly, steel and aluminum tariffs are tied into what we're doing with China and the USMCA. Fourthly, auto tariffs. The auto tariffs under National Security Section 232, that the President has to make a decision by February 15th on that. And the likelihood is we will see auto tariffs. It's not if, it's going to be the scope of those, unless the White House tries to use the shutdown as a delay for those. And lastly, what's happening with our negotiations with the European Union and Japan. In the limited time I'll have, I'll just talk about the first couple of those. Right now, I want to caution against the media narrative that we are close to a deal with China and what a deal means. There's still a lot of work to do. You may have saw the President's tweets from last night that there is still a lot of work to do with China. I am optimistic that we'll have an announcement of a deal. The question is what's going to be the scope of that deal. All of that, we can talk about that all day, and I know others on the call will as well, on the webinar will. But let me just say that the likelihood of a deal does not mean we're going to go back to the way it was in pre-March of 2018. All it means is we will not continue to escalate the tariffs that we have. We won't put on new tariffs. We won't go from 10% to 25% on $200 billion, which we should have done on December 31st, but for this deal. So for those of you that are impacted by the tariffs right now, it's highly likely that after March 2nd, particularly if you were in those first and second tranches of tariffs of $50 billion, that those will remain in place and will for the foreseeable future. And then if you're dealing with steel tariffs on China, those will be on for the rest of our lives. So a deal with China doesn't mean we're rolling back tariffs. So if you haven't filed for exclusions on those List 1 and List 2, you need to do that now because, well, actually time has ran out, but I think there'll be a new round of that opening up very soon. The question is, how does the China deal and what the reaction to that is going to impact how NAFTA flows? If the President and USTR Lighthizer are able to get a great deal and the market responds favorably and Democrats see that maybe trade isn't an issue, they got enough other issues to tackle the President on, perhaps now the new NAFTA and steel tariffs will have a smoother ride in Congress. The likelihood is we're going to get some kind of half deal with China where China's agreed to do certain things and then we're going to be in wait-and-see mode to see if they implement. If the Democrats attempt to take on the President and say he's going soft on China, that's going to mean a bumpy ride for the new NAFTA. So turning to the new NAFTA, known as U.S.-Canada-Mexico agreement, number one thing before we talk about politics is that companies should be pouring through that to see how it impacts them. There's actually a lot of good news, and we talked about that during the last presentation. There's a lot of red tape cutting. There's a lot of things on customs and streamlining your customs operations that can be done. We have reports on every chapter of the new NAFTA that we can work with you and talk about how it may impact your operations. But most importantly, what will be happening over the next year, no matter what happens in Washington politically, is the three countries have to develop uniform regulations, which are how you actually implement this deal. If you're not, what you need to understand right now is how will this deal as drafted impact you, so you know how to change or potentially modify those uniform regulations. So if there's something bad in there, we can maybe move the word or move a comma here or get some new, so there's another round that can be very specific for you to understand, but you're going to have to really closely follow that uniform regulations piece, because that's the world that most of us live in. It's not really dealing with the language of the agreement, it's dealing with how the respective governments will implement it. So that process will continue. Now, in terms of when will USMCA come up for, as I said, the earliest that it can be considered is March 15th. We're likely looking into the spring right now. And then that means if we start the consideration in the spring, that means fall by the time we could actually get it through the U.S. Congress when you start looking at the legislative calendar. So no matter what, we're talking, and then you can move into late 2020 and late 2019, which means we're getting into 2020 electoral politics. So the strategy for Democrats will be to delay this as long as they can, because the reality is the status quo, the existing NAFTA stays in place for the foreseeable future. So unless the president does something otherwise. But so I think realistically we should look at early spring to be when USMCA will come up for consideration, and then that'll start a legislative process. Where are the areas of contention? Labor, labor, labor. One of the provisions of the USMCA is that Mexico was supposed to implement its new labor reform legislation by January 1st of this year, 2019. Mexico didn't even introduce the legislation until December 30th. That will not be considered until February at the earliest in the Mexico Congress. So right now, Democrats in Congress will say, hey, Mexico hasn't done what it's supposed to do. That gives us reason for delay. But I think you will see a lot of talk around labor enforceability. There's also the issues around pharmaceutical intellectual property protections. There's a coalition of 70 entities that have now come together to challenge patent protections under the argument that the new NAFTA will raise prescription prices. Reasonable minds can disagree on that. Maybe unreasonable minds can disagree on that. But keep in mind that this is the exact fight that happened for the Trans-Pacific Partnership. If this trade debate becomes a healthcare debate, we got a problem. Largely because every Democrat that was elected, newly elected Democrat, was elected because of affordable prescription prices. That was the campaign message. So we have to, for those that want to support passage of the USMCA, if this becomes a healthcare debate, it's going to be a very bumpy ride beyond the labor issues. And so there's going to be a lot of noise. Keep in mind for companies, the new NAFTA, the existing NAFTA stays in place until we have a new NAFTA, unless the president withdraws. If you do see information that the president's issued a notice from withdrawal, keep in mind we have 6 months until that would actually happen, and nobody knows what happens at the end of that 6 months. There will likely be court challenges. Congress will step in. So I think most companies should rest assured that the existing NAFTA will remain in place for 2019 until we have a new one. Just finally on steel and aluminum tariffs. Steel and aluminum tariffs, I think there may be 2 windows to get those resolved. One will be after the note, whatever happens with China by early March. You may see Republicans in Congress saying, Mr. President, if you want us to support us on whatever you're doing with China, lift these tariffs, particularly on Canada and Mexico, because that is impacting farm country. I don't think that will actually happen. I think the president will keep the steel and aluminum tariffs in place as a negotiating chip to get votes for the new NAFTA. So I think the earliest that we'll see steel and aluminum on Canada, Mexico lifted is probably in May, if not later, when we start considering the new NAFTA. And absolutely finally, I'll leave it to others to talk about Europe and Japan, but auto tariffs, we will see auto tariffs. It's just going to be a question of the scope and who gets an exemption. Canada and Mexico did strike side deals in the USMCA. Side letters, those side letters that are part of the USMCA do not require ratification by Congress, so they're effective the minute they're signed, which was in late November. So the Canada, US, Mexico auto industry should be largely secure from auto tariffs. But we're really going to see, is the president going to take a narrowly tailored approach on auto tariffs or something much broader and perhaps exempt Europe, Japan, and China while we're having these trade talks? So that's mid-February. So around Valentine's Day, President's Day, we'll start seeing some things on auto tariffs, and that may shape the narrative on China. I can tell you right now, when the U.S. Trade Representative met with Europe and Japan last week, the specter of auto tariffs was there, and the idea was that the U.S. position was, Europe and Japan, you better get tough on China before March, or you're getting hit with auto tariffs, because the U.S. is trying to use European and Japanese leverage on our trade negotiations with China as well. So all of these things are interconnected. Where does that leave us? I think it's very important that companies stay up to date as to what's happening. Global Chamber is a great resource. As I said, we at Dickinson Wright put out regular information, and Global Chamber sends that out. But don't panic. There are opportunities to really see competitive advantages, but you have to know what's going on. But I am a bit concerned about the number of companies that just think this too shall pass. This is not passing. So get engaged, understand how this is impacting your supply chains, and then there's a solution to these problems. There's a solution if you want to re-engineer supply chains and other things, but you have to accept that there's an issue first. And so with that, I'll turn it back over to you, and I'll take your questions later. Thank you.
Great. Great, thank you, Dan. Yes, we will hear from the speakers and then we'll ask the questions, and so we'll have time. So if you have a question, please enter it into the Q&A box at the bottom or in the chat area, and we'll handle it that way. Our next speaker is not lax around his own business, around trade. He's on top of it and proactive, and that's why Jim is here. James Ratcliff is the chairman and CEO of Rowpar Pharmaceuticals. I don't think I've ever called him James before, but he's an extraordinary leader with his company, not just with what they're doing with products like Closis in the oral care area, but also they've been really on top of exporting all over the world. And in particular, lately, Jim has been up on some exporting to China and trade with China. So I'm sure he'll touch on that. Jim, thank you for sharing your knowledge today.
Well, thanks, Doug. Thanks for having me. Want to touch on 5 things in terms of accelerating export. One is know your motive. The second is know your product. The third is know your country. And fourth is know your partners. And fifth is know your financial model. Let me just walk through those real briefly. Our purpose as an organization is to help people get well and stay well through improved oral care products. Our closest brand is best in class in the United States, and is a market leader in mass, recommended by doctors and dentists, and offers as a superior alternative to the grocery store brands. Why is that important to export? When you go to export, then you need to be in country and focused with a partner who can convey that value proposition. So for a premium product, we need to have customers who have the education to appreciate the difference between one oral care product and another, and we need to have a population that is affluent enough to make the purchase. Okay, so that automatically defines in interesting ways where we go. Yes, we are in some BRIC countries, and you might ask, well, why is that? You know, we are working on a Russia deal. We have we launched in China starting in January of this past year. We have partners in those countries that focus on that demographic and have that capability to convey it. I'm going to Arab Health next week to meet with potential distributors in country, and one of the first filters that we make is when somebody tries to approach us to sell our product on value. As a premium product and as a little guy in a great big market, the last thing you want to do is compete on price. Because the big guys can do, on an economy of scale, can squash you like a bug. So knowing your products and knowing your motives, it's sexy and it's adventuresome to go global, but that's not the reason you should be there. The reason you should be there is because of a great opportunity to grow your business. Know your in-country market. We most of our retail distribution is through name store brands, so Walmart, Walgreens, CVS, Amazon are market leaders on one side, and then we have synergy with the professional market. That is, doctors are making the recommendation and sending their patients to those retailers, and that requires a set of relationships on the professional side. Now you go to a country like France. We're not in France. In France, you don't have a bunch of great big retail pharmacy chains. You've got 32,000 single pharmacies that are then buying cooperatives. Buying cooperatives, probably the closest would be McKinney or Drugs or McKesson here. But that's the principal market. So you say, how can I get my value proposition across there? And by the way, in France, you're not going to see the dentist for a recommendation about toothpaste. You're going to see the pharmacist about a recommendation. So when you make that assumption about how you go to market, you can make that assumption in Britain because there are chains like Boots and Sainsbury and so forth. So you can say, my marketing model might fit well there, but when I go to the next country, does it really fit? That means then that you have to have a good choice of partners. And so when we went to China, for example, we first of all vetted partners. They have to have the capability to reach an enormous population. Where we have 10 million or 6 cities that have 10 million or more, and China has something like 200. So it's an enormous market. And so the partner you want has to have the wherewithal and the expertise to penetrate that market. And sure, as a small company, and most exporters are small companies, they're not going to have the indigenous or the capability to penetrate a market like China. So partnerships are absolutely essential. Okay. So what did we do to vet our partners? First of all, our partners are selling 6 other U.S. dental care products. So they know the expertise of the area and they have a successful track record. And we can go and call those business references and say, hey, have they knocked you off? Have they really developed the market as they promised? I'll give you a contrasting view. We've had a couple of dentists who are absolute lovers of our product. One down in Sao Paulo, another one in Lima, and they both run dental clinics. They love to import our product, but do they have the expertise to actually help people get well and stay well by distributing and conveying the value proposition beyond their own single dental clinic? So those
take about 30 seconds to wrap up.
Sure. And so, and the last question, and you've heard me say this, Doug, and that is know your financial model. If I can make a buck in the United States and I've got an enormous market here in the United States and I know how it works, why would I then take a buck and invest it internationally? And the good news is there are answers to those questions. And finally, yes, we are a victim of the president's decision to use executive authority to implement tariffs. We need only think about the Smoot-Hawley period as a precursor to the Depression, and we need only to look at the conference board to see that this CEO agrees with the 800 others in the survey that say recession is on its way. And finally, we need to remember that the Tea Act, which caused tea to be thrown in the bay, was a tariff implemented by an executive unilaterally without the concurrence of Parliament.
Gotcha. So we're predicting things to be thrown into the base.
So be very careful about
Stay away from
the enthusiasm of people with managed markets and managed trade. We have a board member who sells pistachios. 100% of his crop went to China. 0 went this year. Wow. We have relatives in Indiana that sell soybeans. Prices down 20%. Don't kid yourself about how we can manage this. This is the new normal.
Thanks, Jim. We're going to shift over to tech, and so Ian McClarty, president of phoenixNAP, is not only a leader in the tech industry with their data centers around the world, but he's a Thunderbird guy too, so he's extra special. So Ian, thank you very much for your time today, and looking forward to seeing how your perspective on the general state of the union in tech. I think you're going to touch on 5G in the marketplace, and then also protectionism around tech. Thank you for your time.
Thank you very much. So I'm going to start first with a quick look back at 2018, just so we know where we kind of are, where we're at, and then where we're heading. And I'll try to keep it short for the team. So what we saw in 2018 was a big shift in buzzwords, right? So meaning AI and IoT, they started to become a reality. We actually are seeing those workloads now in the real world. Before it was a lot of startups and a lot of entrepreneurial companies doing those workloads. Now we're seeing those workloads actually penetrate the enterprise. And so we're seeing more and more needs around how to better service those very distinct workloads from traditional infrastructure services. And now also those for 2019, we're seeing those workloads better redefined with things like machine learning and deep learning and smart analytics. And we believe that that's going to continue to be a trend for 2019. Worldwide, what we're seeing is telecom prices are dropping. We're a large consumer of telecom services from a worldwide perspective. We're purchasing telecom in countries all over Europe. We are currently in 7 different countries in Europe and also in Eastern Europe, and we continue to see prices drop. In Europe, they're very similar to the U.S. In Asia Pac, we're also seeing a massive drop, even though they're about 10 times more expensive. We are seeing that they are getting more aligned with where we were at, 7 years ago in the U.S. From a pricing perspective. So we believe the price, especially with 5G coming to the market, is going to continue to drive more and more latency concerns. So companies that want to be really global, they need to be distributed globally. And we're seeing that trend as well. We're seeing that first with ad tech. Google has also dropped a lot of the requirements around what they consider to be a successful ad placement. It used to be 100 milliseconds. Now it's dropped down to 70 milliseconds. What that means is that a company that is bidding on your ads that are displayed when you're web browsing or video surfing, those are done in almost real time now. I mean, you're basically, and they're competing with each other. You have ad tech companies all over the world that are trying to get closer and closer to the consumers that are worldwide, and basically they have a bid process. So they go back and forth, and whoever wins the bid then has that small amount of time to display the ad. And so now we're talking about the real world transactions that are happening, very similar to how the large stock exchanges happen. So we're seeing increased growth in ad tech as a result. One of the things that we a little bit of our company, we're incorporated in multiple regions. So we're obviously a U.S. company where we started in Phoenix, Arizona, but we incorporated in Netherlands. We're also incorporated, that's our European headquarters. We're also incorporated in Serbia, and we're incorporated in Malta. And what we have noticed is an increased demand because of Brexit in Netherlands for services. So a lot of not just European companies, but even English companies are moving to Netherlands because of the close proximity and the business-friendly climate, especially in IT, that happens there. So we continue to see an increase in demand for Netherlands services. Even just moving people physically from England because of the volatility now to servicing call centers and just starting to tear down their services levels so they can be up and running and not have to worry about it. So some companies have been doing that for 2018, and we consider that it's going to continue to be a trend in 2019 as well. One of the things that we're seeing as a big driver is data privacy worldwide. So a lot of countries have in-country law that is specific to keeping data sovereign for their nations. And that's also driving more and more data center growth worldwide, which is taken away from the U.S. It used to be that companies would host services in the U.S. because the infrastructure services were not available worldwide. Now we're seeing an increase in service level and availability of different providers, an increase in that. We're also seeing more and more of the larger data center operators building in multiple regions. So there's more competition happening, which is helping drive costs lower. There's still a vast difference between power costs, though, when it comes to the U.S.-centric prices that we have compared to European, and then compared to Asia-Pac countries is significant. I mean, we're talking about 3-fold to 10-fold, depending on what region you're talking about. So a lot of our clients do get sticker shock when they go into regions as they're moving out from Europe and also from the U.S. into obviously more exotic regions, right? Singapore being one of them, Australia being the other. But they are definitely we can see the trend in growth there. We also are getting more and more demand for Sao Paulo. So that's something that we're going to bite the bullet this year. We've been avoiding Sao Paulo like the plague, and not because it's not a good market, but we have noticed more protectionism happening in Sao Paulo, from a data perspective and also from a tariff perspective. So it makes getting equipment in and out very difficult for us, and the sourcing of equipment is just going to drive our costs even higher. Cybersecurity, with everything said, is at the forefront of technology right now. Countries are becoming more and more protectionism. We're seeing more and more increase in cybersecurity for their own country. The U.S. is passing a lot of, I won't say laws, but a lot of, they're coaxing companies to really ramp up their cybersecurity efforts from a private perspective. We're part of an organization called ACTRA that is basically it's a liaison between government and between private enterprise, and how we can share information in an anonymous manner better with each other as they're seeing bigger and bigger threats coming. So as we become more worldwide, the threats are also coming in at the same time, which is kind of funny. It's very much a polar opposite effect. We forecast that in 2019 we're seeing a big move into what are called public cloud services. That's basically your big AWS, Azure. The big players are really the compute model of technology. Today, enterprises for 2018 were spending about 80% of their revenue, of their budget on traditional on-premise services. More and more of that is forecasted to move over the next 3 years to public cloud. So we will see a bigger demand in public cloud services. With a big caveat, that's if there's no major security breach in public cloud, that will continue to be the trend. About 40% is going to go from the 80% is going to go into that spend of public cloud services. On-prem is going to go down 26%, and then software as a service is going to be about 34% is what is being forecasted. So really a lot of growth market in IT from those perspectives, but the traditional enterprise buying of hardware is really going to stop, and it's going to become a much smaller pie, a piece of the pie. And that kind of is kind of a general overview.
Great overview, Ian. Thank you very much. We'll kind of build off of some of the things you were mentioning there, especially in Europe. René then Baardewijk is the owner of Rebain International. He's based now in Barcelona, Spain. However, he started in Australia, spent 20 years in New Zealand. Maybe I have that reversed. But he's also worked in 100 countries, the Netherlands, Spain, Niger, Venezuela, Uruguay. Probably it's more challenging to find a country he hasn't worked in than one he has. And he's right on top of a lot of the things that are going on right now in the world around exporting. And lo and behold, he also is a special person because he also went to Thunderbird. So René, thank you very much for your insights today.
Exactly. Good evening from Barcelona, Spain. Indeed, it's good to see that there's more T-birds out there, and not unexpectedly with the international trade. The introduction was almost correct in the fact that indeed I started the business in Auckland, New Zealand, actually more than 20 years ago. The company Rebain International is a chemical supply company, so we offer raw materials to a variety of industries such as paint industry, detergent, cosmetics, chemical preservatives, food, pharma, so quite a variety of applications. Nowadays we have offices in Australia, near Barcelona, Spain, as well as in Rotterdam, the Netherlands, and a number of sales offices throughout the world, from where we basically try to supply our customers with the products that we have to about, I think at the moment, about 50, 60 countries we are supplying actively, maybe a little bit more. It's interesting to see, as my colleagues here before we're talking about the provisions for 2019. As you know, we're in January, we just had the end of the financial year, and normally we make our forecast of what's happening, but we also look a little bit back on last year, and it's always interesting to see that the total turnover was about right as what we forecasted, but the where we sold it was totally different than what we thought, and that all has to do, of course, with all the international activities, the things that happened, the trade war between China and the U.S. Argentina is a good example, and until June, July, we were actively selling there. We have some good customers there, and then due to the economic problems there, basically the sales just dropped, and by about 80%, and that all has to do with the economic developments. The China U.S. trade war, as you may call it. Of course, for us as a supply company where we buy a lot of our product, we are not a producer. We buy a lot of our products from Europe. You know, in a way, we see that as an opportunity, because if a lot of the products that the U.S. buy, a lot of the chemicals traditionally buy from China, and they get a higher duty, that obviously that means an opportunity for European products. And we as a chemical supply, as a trading company, of course, have to be on top of that opportunity. Another example is, for example, the business we have in Cuba. As you remember, under the previous administration of President Obama, United States was close to ending the embargo, which of course now hasn't happened with Trump, which for us again is an opportunity, because in Europe we do not have the embargo, so we are allowed to sell and trade with Cuba. And of course, if you look at it logistically, it would make a lot more sense if Cuba would buy a lot of the raw materials from the US, but it's not possible under the current situation. So other companies and other countries are doing that, but of course we are also restricted, because if we buy from a raw material from a multinational company that has activities in the US, they can actually not supply, not even to us, knowing if they know that the end destination is Cuba. So there's a lot of things that the international trade market is affecting us in any way. Brexit, of course, is a big thing. What will happen, or will it not happen? Will it happen? Everybody is looking at that closely, especially the countries surrounding the UK, which of course mostly Ireland, but also the Benelux countries. These are things that for us, if we are trying to forecast 2019, it will be very interesting if what will come true. In our business, everything has to do with things like licenses, the mergers. It can have exchange rates risks, anti-dumpings, and these things can change overnight. I just got back yesterday from Uganda in Africa. Just to give you an idea, we're supplying a customer in Uganda with a product which we buy as a Spanish company from a German producer, which is in Berlin, close to the border with Poland. So we bring the product from Berlin to a port called Szczecin, which is in Poland. And from there, it goes to the port of Mombasa, which is Kenya, because Uganda doesn't have any natural ports. And then from Mombasa, it goes to Kampala, which is the capital of Uganda. So just with one simple trade deal, we have to do with 5-6 different countries and 5-6 different regulations, which can really cause a problem sometime. And then you have the different countries, the different languages in the different countries which you have to deal with. So it's for us, international relations, I mean, that's the thing we live. I mean, we get up in the morning and we talk with our Chinese and Indian suppliers because of the time zone, and then later on in the afternoon the Americas starts, United States, Canada, Latin America, where we have a lot of our customers as well, and they come with their inquiries. So it's a 24-hour business. And to give you an idea, at the moment we're trying to get all our orders from China fixed, because the first week of February will be the Chinese New Year, which means they're going to be on holidays, and usually the prices are only valid until that time, and after that they tend to increase, or at least they try to increase them. So we're trying to force our customers to take a decision before that. So that's another example of how international relations affect our business. But I guess that's what our business is also based on. As a trading company, we're trying to be on top of that and helping our customers that need constant supply of product to smoothen it, and to advise them in advance that something may be happening, or there's a change, there's a factory which is not producing, there's a change in the exchange rate, whatever, so that they get their product in time. I guess that's most of what I can say at the moment. Thank you.
Thank you, René. If only these politicians were both sensitive and knew about what you have to go through on the trade side of things, right? I mean, why can't we all just get along? is I think is a famous phrase, and it just doesn't seem to happen. Maybe someday, if Mel was a leader of the world, it would happen. I'm sure. She's
Yeah, well, it's actually it's 100% right. On the other hand, a trading company such as ours, in the ever globalizing world, of course, where nowadays via database every producer has access to every customer and vice versa. Of course, we also live a little bit by the fact that there's always change and change in tariffs, change in trade wars or real wars, and of course those companies that are focused on and are on top of those changes can of course also benefit from that.
No question. One person who knows a lot about that is Mel. She's the Vice President of International Affairs for Freeport McMoRan, which you may know is the largest private company making copper in the world. She, before that, spent 20 years in the Foreign Service with the U.S. State Department, and one of her favorite places in the world where she knows anybody and everybody is Democratic Republic of the Congo. So she spent, I believe, 8 years there. And so above and beyond that, she is an amazing person in every way. And one of the great things she does in the state of Arizona is volunteer for a lot of groups and support a lot of groups, including Global Chamber, but she's also the head of the District Export Council for the state of Arizona as well. So, and to tie it all the way back to Dan, she went to college at Xavier in Cincinnati, which isn't quite Columbus, but it's almost the circle.
It's in the same state, although there's a traditional animosity between Cincinnati and Columbus.
Oh, sorry I brought that up. So you're going to be talking about maneuvering in the trade war for global companies, which you work for.
Yeah, and thanks, Doug, and thanks to everybody who's taken part. And hopefully this is an interesting discussion. I have found it to be so. I want to start from the particular and work up to the macro level. And as I am an economist, that's the way I have to do it. I want to talk for a second about our processing center in Stowbridge, England, which belongs to a wholly owned subsidiary of Freeport called Climax Molybdenum. And what we have in Stowbridge is what we call a roaster that processes molybdenum. From Stowbridge, historically, we've been able to export throughout the EU into Latin America, and upon demand, which is not high but exists, into Africa as well. Taking advantage, of course, of England's status as the EU country and their broad array of EU trade arrangements. Well, we're looking at a problem with Stowbridge, because whether Britain crashes out with no Brexit, whether they limp out with some sort of cobbled together mixture, it raises the issue for us of what happens to our capacity to export to the world, because Britain is going to be in a position of having to renegotiate bilaterals all around the world. So that's going to be a lengthy process. It never goes smoothly. And it's going to have a huge impact on a facility which, classically for the industry, we can't easily move. We've got a lot of money sitting in the ground in Stowbridge. So let's talk about Ireland for a second, the big stumbling block in Brexit. I think Ireland has a terrific opportunity, and they know it, to become a supply chain alternative as an existing member of the EU, with EU insistence that they maintain that free gateway. So companies like ours that have embedded assets are going to have to be looking aggressively at taking advantage of the limited capabilities to find flexibility in how we do our supply chain coming in, because we produce the raw materials in Chile. We ship them to the UK. We process them and then rebound those out to where our clients exist. So I think Ireland has a great strategic advantage. Britain didn't mean to give it to them, but it exists. These are unintended consequences of managed trade.
Yeah.
And I 100% agree that, like it or not, we're stuck in a march to managed trade, at least over probably the next 5 years. Why do I say 5 years? Talking again about what we see as an industry with assets embedded in the ground. It's about 5 years ago that I started talking about a thing that I refer to as legalized nationalization. There are several aspects to this as you go along the train of consequences. It starts with countries deciding that they don't like contracts, but not wanting to look like they're abrogating a contract. So they go and change the law. And then they say, aha, your contract no longer conforms with national law. So either rewrite your contract voluntarily, or we will pass a second phase of the law, which will change the ownership structure of your company. This is what has happened to us in Indonesia. We got caught in a slow-moving wave of legislation that played out over about a 5-year period in total and wound up with the Indonesian government having a law that says all mining companies have to hand over 51% of themselves to the government or its agent. Legalized nationalization. And the heck with your contract, the heck with your protections. We see it playing out in Africa. DRC, alas, my beloved country, which is not exactly a trade powerhouse, but nonetheless a country which is very alert to its opportunities, highly dependent on mining, followed that lead very quickly, recently changed their law, moving towards having all the companies turn over majority ownership. Zambia right next door, moving in the same direction. So this is why I'm saying 5 years, because it's about 5 years ago that our industry started seeing this paradigm shift in attitude. And it goes hand in hand with politics. We have the politics of nationalization. We have the economics of managed trade. Those two are long-term partners. Tim referred to Smoot-Hawley. That's a great example because the politics and the economics go together. On the global scale, what's being talked about at Davos this year is fascinating because it sounds broad and it's actually fundamental. Why are we seeing the changes that we're seeing? Why has managed trade become popular again? Why is nationalism popular again? Because we're living through some fundamental economic distortions. Labor, 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 100%. But not even labor in the classical sense. Labor in the sense of stagnant wages, labor in the sense of lack of upward mobility, labor in the sense of unable to access skilled workforce in sufficient numbers where it is needed, labor distortions in the sense of the huge anti-immigrant waves around the world, fundamentally a lack of hope in the working class, that the leverage exists to change this. Coming back to let's throw the tea in the harbor. It's why we're seeing the governments that we're seeing in the world, in Poland, in Hungary, in Brazil, in this country, because people are in the mood to throw the tea in the harbor. And that's what's being discussed at Davos, because the consequences of not talking about the big fundamental issues are not just market volatility, which is bound to continue this year going forward and become probably worse. It's not just distortions to supply chains and complications for companies that can barely keep up with all the devil in the details hidden in these 150,000 page documents. Thank God for companies like Dan's who are willing to do that work. It's about people. And if we can't get it right for people, the consequences for business and governments and countries will become increasingly negative. Sorry to be a gloom and doomy. I'm usually an optimist. Today I'm wearing my realist hat. That's what I can see coming.
5 years.
Yeah.
It's going to take to work through.
Yes, because the policies that are already being put in place now, you can't just suddenly snap your finger and say everything's back to normal, because it goes to having to restructure your supply chains, having to restructure your labor sourcing, having to find new markets, and all of those entailed costs. So as nimble as businessmen want to be, the politics is going to take years to unwind.
Okay. So Dan, I'd really love for you to rebut that, but I'm thinking you might end up agreeing with that. And while I'm coming back to you to ask a question, and I'd like to second Mel's comment about we're so thankful to have people like you who can wade through the masses of paper and figure out kind of what's going on while all this chaos of managed trade happens. So thank you very much. Are you, the way you started this whole thing, Dan, was saying that kind of get ready for a long haul, and that's just what we heard from Mel. So you want to add any comments to that? Does 5 years look like a window that before we kind of get back to some unmanaged trade or a little bit more open market trade?
I agree 100%. And you know, look, I grew up working in a steel mill in Youngstown, Ohio, which is ground zero for a lot of these issues. And they'll tell you this debate's been going on for 30 years, if not longer, right? It's just, and I do think we did this too quickly, in my opinion. We globalized so fast, and then you can't really control that. But what we're doing is we're correcting what the mistakes of the 90s and the late 90s and early 2000s, and then we had the Great Recession, and we're dealing with all the consequences now. So I don't necessarily disagree with the administration's view that we need to rebalance. It's just how do you do that? And they're causing this disruption. But I also agree with what René said, and I think everybody has touched on this. That doesn't mean companies should sit back and do nothing. I mean, there are competitive advantages and opportunities out there if you take advantage, but you have to know what's going on first. And look for that. But there's been this willing denial, and I think a lot of it, you know, I spend a lot of time in Washington, the big trade associations or elsewhere, where the idea that we're ever going to go back to the way it was from, say, the mid-1990s to 2018, we're never going back. And my biggest fear is that if we start seeing more and more job losses in the white-collar field, automation's already hit manufacturing. Right. Actually, the automation that's happening there, we like. But automation in the white-collar world, you're going to see more and more people push back on globalization. So trade is a people issue right now. But that being said, I don't think it's pessimism. I think it's realism, and I think companies need to adjust and adapt to it. This isn't an isolated phenomenon. We're seeing this around the world, what's happening right now, and we have to react as companies, and how do we find opportunity?
Gotcha. Another thing that you said, Dan, around China and particularly the U.S. pressuring its allies, UK, Germany, I presume Canada would be in that case, is what Canada's doing with Huawei an example of that? Same thing with Germany. I mean, are there things kind of like undercurrents where there really is, you know, there's talk of like disbanding NATO, and yet there's still allies that are potentially now China versus the world? Is that kind of another one of the factors that's going on top of everything else?
Well, in my view, yes. I mean, the reality is that the U.S. came along in 2018 and said, when it comes to steel and aluminum, everybody agrees China's dumping steel. Everybody agrees from 2007 forward that was China's strategy. It's what do you do with it? And, you know, whether you love the Trump administration or hate, their answer was, we've talked about this long enough. We've had G20 summits on it. We've done G8 things. We're going to put on tariffs, you know, and that's going to help compel countries to, if you want to keep dealing with the U.S., you're going to have to get in line with us on this. It's kind of, I hate to use the phrase you're with us or against us, but that's basically what the view is. Because this administration, we've talked about this in past sessions, it views China as the largest national security and economic threat. And it's no different than administrations prior to us viewed Al-Qaeda and ISIS. They see it through the same lens. And when you talk to them, it's the same language and rhetoric that's used. But the problem is, and I think Melissa would understand this more from her experience at State, is there's these other things that pop up, these things you can't control or predict, like Huawei and an extradition request. And all of a sudden, Canada, who a year ago was trying to negotiate a free trade agreement in China, this has done a complete 180 in Canada-China relations. And so, and it's because there's these situations on the ground you can't predict and you can't control. But the flip side of that is, what if Canada didn't react? Then it's violating extradition treaties with the United States. You can't say on the one hand we're your most natural ally, security partner, and not agree to extradition. So, I think these are the things that are the unknowables, and that's why I think we'll continue to see volatility in the market. We don't know what's next, and this assumes a Washington that's actually normal. And I think Washington could get very ugly this year with various investigations and things of that nature. Look, they haven't even turned the lights on there yet in 2019. So in terms of the shutdown, so that's why when I look at USMCA, we have to have some realism and say, how can we pass a trade agreement this year when we can't even turn the lights on in Washington? And so, and I think companies need to prepare for that.
Great, thank you. We're going to go about 5 or 10 minutes over. We're about 3 minutes to the top of the hour, so we've got some additional questions. One is actually from Ian asking René, one topic we didn't talk about was GDPR, and data protection and data security. So how is that impacting, what you're doing in Europe, and how much of a factor is that? And if anybody wants to bring that up relative to what its now rollout to the rest of the world might be. René, how about you?
Yeah, I mean, on data protection, we have, of course, the laws here in Spain, or I would say in the EU, because I think it's the same where we have to provide data protection, and we definitely have some things we implemented, I think, last year. As far as export go, and with other countries, be it Latin America or Africa, I think that's less of an issue still at the moment. But of course, if we're dealing with the US, and of course we're also dealing with their legislation, so we have to definitely take that into account. Whereas in other countries and areas, it will not be so strict yet. Here in Europe, they've become quite strict on it as well. We cannot just use data. Yeah.
The one, going back to Dan for a second, one thing you didn't mention was AMLO in Mexico. But by the way, your video is frozen, so I apologize for that. But we can hear you, so it's fine. So is the USMCA going to be approved by Mexico?
Well, yes, I do think, I think both Mexico and Canada, they've started the legislative processes, but they're going to wait to see what the U.S. does on this. Keep in mind, AMLO's had a very busy month. They raised the minimum wage in Mexico. They declared a northern border zone, which would be our southern border zone at the border there, which eliminates some VAT and has different minimum wage requirements, and they introduced the labor reform. So for companies with North American supply chains, all of the attention right now is on Mexico, and that's assuming, again, we talked about unknowables. We have a gas crisis down there right now. On various issues. So if you talk to anybody in Mexico right now, they're having lineups at fuel stations right now, and that started to calm down a little bit. But and so I think Mexico does have majorities. Canada has the parliamentary system with the majority government. But keep in mind, we got to watch Canada closely. They have an election in October, and if this thing goes into there, we're going to have to watch what's going on. Will USMCA become an election issue? I don't think it will right now. But you never know, and I think that all adds to the kind of the uncertain politics around this.
Okay, you mentioned something related to that with the prescription drugs, and so that part of it, doesn't USMCA, does it protect pricing, keep it higher, or doesn't it open up lower pricing? What's the issue there?
The issue is, it looks like I'm frozen. I hope you can hear me. The issue is that pharmaceutical companies have asked for a number of years for patent protections, basically because of so much of the R&D that pharmaceutical companies put in to have patent protections. There's differing standards in North America. We ended up at 8 years, and 10-year patent protection in USMCA. Canada had never been willing to go higher than 8 years for that, including in the TPP. And so this right now, the pharma in the U.S. wanted 12 years, and they got 10. So we kind of split the knot there. But just yesterday, a group of 70 associations came out, largely left-leaning, AFL-CIO, et cetera, challenging this provision. So I think there's the potential for this to become a trade or a healthcare debate very quickly. Keep in mind, Canada, of course, has publicly funded healthcare. And so the argument in Canada is that this is raising the cost of prescription drugs and delaying the generics. So we'll see what happens. This was a big problem. This was actually the thing that stopped the TPP, among others, from going forward. So for some of us, this is living this nightmare again in some ways.
Good. I'd like to ask each of you to take 30 to 60 seconds and just maybe recap on what you've heard and how it impacts what you talked about. I think one of the real key takeaways, there's a lot of them, but the unintended consequences of managed trade seems to be the theme here, right? There's lots of people trying to put their hands in it based off of the impact on people and politics, and so as soon as politicians get involved, all hell breaks loose, and we seem to be seeing quite a bit of that. So, based, Jim, on what you've heard, I mean, how do you feel about entering China right now? That seems like a pretty risky strategy.
Well, we grew double digits last year.
Okay.
And all my comments on the gray side to the side, there are opportunities internationally to grow.
Okay.
But the point that I made earlier that I'd like to underscore and really builds on Mel's comments it's not just a bilateral regulation that one has to attend to. So yes, we are concerned about Health Canada and bringing fluoride toothpaste into Canada. But we're also exporting to New Zealand and Australia, and they have different standards for fluoride toothpaste, which then redound to a small business such as ours of saying, oh, are you going to keep a separate SKU for Australia and for New Zealand times the number of SKUs you have in your inventory? So that the point is quite correct. It's been going on for about 30 years or better, but it's amplified by the big guns, the large economies now getting into the fray. So look at the supply chain, look at the relationship between the countries you're dealing with, not just the U.S. and the target in-country that you want to sell to.
So 85% of business in the next 5 years is outside the U.S., and so we can't forget that. So we can't have U.S. exporters afraid and not do anything, which goes back to, I think, Dan's point too, is like just sitting back and kind of watching isn't the action that you need to be doing. You need to be involved. Ian, you talked about, that there's actually shifting, like on the data side, for instance, and data centers and technologies are shifting outside the U.S. So the U.S. is growing, but a lot of the activity, I don't know what percent, but probably well over 50%, maybe closer to that 85% is happening outside the U.S. in tech. So people need to jump in, right? People need to get involved like you are.
Correct. And this opportunity everywhere, right? I mean, so China's a good example where we've taken a position of not to be in China just because of too much volatility for our type of business. But that opens up Singapore as another option, or Japan, or even some of the other, or Australia even, depending on what the latency concerns are for that business. So even other markets emerge. So there's always opportunity. You just got to find it. And we are definitely seeing data sovereignty being a big driver of that. GDPR for us was very impactful. Because it affected our entire supply chain. We had to, as a European company, we had, and also having European customers, and being able to anonymize systems that, frankly, our vendors weren't even geared up to support. We had to do a lot of pushing and a lot of prodding to get them to be compliant even. So it's not even just the effect that we had, it's also the effect of our supply chain.
Gotcha. The last two speakers will go first to René and then to Dan. René, any closing comments that you'd like to make? Do you feel more optimistic or pessimistic or neutral today?
Well, I mean, I always have to be optimistic. Yeah, I mean, things are changing, and again in 2019, so it will be an interesting year again. And I guess only by the end of the year I could say what has happened and what has changed other than I thought it would. But I think in general, though, the economics, despite all the various problems that we've been noted, the economics are still good. At least here in Europe, the economy, the fundamentals are good. The unemployment has been going down for the last few years. I think in the US it's almost at an all-time low. Asia, despite the lower growth of China, there are many other upcoming countries in Asia as well. Africa, if you just go there, you sort of get the buzz of what we had in Asia maybe 10, 20 years ago. So, you know, there's always lots of opportunities out there. You just have to go and look for them, just as my colleague here just said. So, but I don't think it's all that bad. Thank you very much.
Thank you, René. We'll come back to you, Dan, for closing comment. You know, 2/3 of companies not prepared is not a good situation. So we need more people engaged, more people understanding the impacts of these changes that are not going away. So any closing comments from you?
Yeah, I mean, I'm an old Boy Scout, so I just think be prepared is the answer. You know, or, you know, as a teacher told me many moons ago, prior planning prevents pitifully poor performance, right? So that just getting ahead, I think, and I don't blame companies. My clients are busy doing what it is they do, right, every day, and keeping, and you know, running their business, managing employees. We're trying to attract and recruit talent. And so, but I think it's very dangerous, some of the media narratives that we see, that a deal's coming or an agreement's just a rebranding. I mean, the fact is you have to just go back to fundamentals and know what's in a new deal that may affect your operations. Are these tariffs affecting me? Do I need to file exclusions? Because, again, wishful thinking isn't going to get you to profitability or to maintain the growth that we're seeing. But on the positive side, we are seeing many companies thrive, particularly U.S. exporters. There's a lot of opportunities up there. It's always a lagging indicator in our economy. More of our companies should be exporting, and I think there's a lot of opportunities out there. It's just knowing how to get there, and plugging into the global chamber and other places will be of great assistance. But I think you got to get behind the headlines as well and really see what's going on.
Thank you, Dan. Dan, as he mentioned, we've got, oh, did you raise your hand at me? Or
Yes, I did. Yes, I did.
So Dan, I want to just mention that you do great work, and we keep up to date. Whenever Dan has an update, we publish that so we can get that out. And if you need to get a hold of Dan, one person actually I think of you for, Dan, is a guy who's here in Phoenix who has been eating the tariffs basically and marketing it from a standpoint of, you know, it's a tariff-free zone, and what I worry for him now, you know, based on a lot of what I've heard today. So I think we need to get you guys connected. So don't hit me. What were you going to say? Sorry, go ahead.
I would never strike you, Doug. I'm a woman. We don't do violence. We lean forward and raise our hands.
Leaning forward. Yeah.
I just wanted to say, in terms of closing remarks, that putting back on my State Department hat, I think that it's well worth watching China. Because I think what China did last year with the port in Malaysia, it illustrates China's potential. If you really want to push China into a trade war, if you really want China to hurt not just the U.S. but the world, keep on your track. China has been buying agricultural land all over Latin America. They own a tremendous amount of it. They have, for the last 5 years, been buying mineral resources all over the world. They own a tremendous part of it. Through their loan structures to countries around the world, they have put in place means by which they can seize infrastructure, as was the case with the port. Oh, you can't pay your loan? No problem. We'll take your collateral. Thank you for the port. If you really want a trade war, keep pissing China off. My final word would be, tread carefully, oh managed traders.
And so we shall. How do we get that message to them? Hopefully they'll listen. So thank you all for really great comments, great information. They're always available. If you can't reach them through Global Chamber's directory, then just reach out to info@globalchamber.org. We really appreciate all the attendees, and again, if you have any additional questions, let us know. We'll probably post this next week. And so if any of the speakers have any additional information, send it over and we'll include that in the blog post. Thank you, everybody. Have a great day.
Thank you very much.
Thank you.
Thanks. Bye.